Investors and traders, welcome to the channel Market Chart Pattern. Today is 16th of July 2023 and I hope everyone is having a good weekend. In this video we are going to take a look at the US debt markets. We will be looking at the Treasury bond futures. We will cover the long bond future, which is the 30-year bond futures. Then we'll take a look at the 10-year Treasury Note, and then finally the 2-year Treasury Note, and we'll try to decipher based on the price action what the market might be telling us about the interest rate situation, and also the upcoming FOMC meeting, what the Fed might be likely to do, although that meeting is a little bit away, but we will still take a look at the price action to see what the clever minds in the markets are thinking about the situation. So this video is for educational purposes only, and it is not a financial advice. And the bond market is actually a much bigger market than the stock market. These markets are much more sensitive to the interest rate fluctuations, and at times are able to foretell what the interest rate situation might look like. And what we have seen so far is that in these markets have been just going down, down, and down. And what it means is that the yields are going up, up, and up, because in a bond, the price and in yield are inversely related. So what it means is that when the price of a bond is going up, it means it is yielding less. And when the price of a bond is going lower, it means it is yielding higher. So what we have seen is that in these markets, just taking a longer term view, let's go to the weekly chart. So this is the weekly chart of the 30-year long bond futures. It's known as the long bond because the duration is really long. It's 30 years. It's a pretty long duration. So it's in the marketplace commonly known as the long bond, and this is the future on it. So it's a long bond future. So what we have seen is we have seen this price peak in the month of March 2020. So during the COVID era, this is when we had seen the price actually peak, and you can see there was like a peak 1, peak 2, and peak 3. Finally, this one is a very significant one, and what we have seen is a constant decline in prices. In other words, the yields rising, and this is what we have seen. In fact, we have seen the Federal Reserve come in and raise interest rates. So this means that the participants of in this market and overall in interest rate markets, they began to anticipate, because of the actions taken on the monetary policy, and to some extent even on the fiscal policy back then during the COVID days, that this could actually in fact lead to higher inflation, and the policy makers, which is the Federal Reserve, in fact having to raise interest rates. And if you remember, or if you Google old news, during the COVID times, there were talks about negative interest rates. And in fact, in certain countries, like for example in Europe, we did have countries or the central banks which were having negative interest rates. And in fact, in one of the conferences, Jerome Powell, the chairman of Federal Reserve, he was also asked about the possibility of negative interest rates, and it was something he was against. Now, Jerome Powell, based on my research, comes from a background in the credit markets and debt markets, and from a commercial perspective. So he understands these markets pretty well, and he was not in favor of negative interest rates. And what we have seen in fact is rates going up higher, in fact much higher, because in the course of just 1 year we have seen these rates go up pretty much on consecutive basis. However, the participants back in the March of 2020, they were expecting the interest rates to go up, and that's why we saw a peak in the price of the long bond future. And during that time, there have been rallies, for example, but those rallies were short-lived, and in fact might even be around some sort of Fibonacci numbers that we like to take a look at. Here we go. So this one was right at the 38.2%, just shy of it, and then we have seen similar rallies, in fact, decline. And this is the concept of the market symmetry, because this market has a negative symmetry in place. What it means is that whenever the market actually rallies by a certain amplitude, it encounters a high resistance and is not able to take that high out. So in fact, then it begins to roll over. And what we have seen now is in the recent months, since October of 2022, it's the market has been forming this sort of which I like to call a McDonald's arch pattern here. However, we were anticipating about a couple of weeks ago, about 3 weeks ago, that perhaps this trend line here might hold, but the week of 3rd of July, it broke down convincingly. But the last week we have also seen, that's the week of 10th of July, a rally take place. This is quite common, because what is happening is that the price actually reached right here, which could actually in fact provide some structural support as well. And here we go, around 122. But it looks like the market has been anticipating perhaps some sort of interest rate hikes to come in, and that's why we have seen a sell-off and then some sort of a retracement taking place, which we'll take a look at the lower time frame charts. So let's move to, here we go. This is the daily chart of the Treasury bond futures, which is of 30-year duration. And here just the concept of market symmetry, just to highlight it again. It'll be a little bit easier to see, although the chart might be a little more squeezed. What we have seen is that, whenever there has been a rally of about this much, so this one was a little bit lower in this is a bigger rally, we have seen a decline come in. And if we take this and project it from here, pretty much the same thing, a decline has come in, and then this much here, and the market was not able to take these highs out, although there was a really good attempt by the market to do so. And in fact, at one point we were also looking for this ABCD pattern formation, which is an extended ABCD pattern coming right at the 78.6% Fibonacci retracement, highlighted in the yellow area, to hold. And we also had this trend line coming in as well, but that broke down convincingly, as we have seen on the weekly chart. And now what might be happening is that over the course of few days last week, we have seen the price move higher. It might go and touch this level around 128, and that's where we might actually see some resistance come in and selling perhaps resume. We'll have to wait and see. And it's also just in the area of right about where the market closed, or in fact it touched that 38.2% Fibonacci retracement right around here from this high. So this is the region that is very important to be watching in terms of what the price is likely to do. Now let's take a look at the 10-year Treasury Note. Here we go. So similar sort of picture in the trend 10-year Treasury Note as well. This is a bigger market than the 30-year futures, or the 30-year Treasury bond. This is also this kind of duration of Treasury notes is also frequently used in terms of benchmarking certain kind of rates which are used against let's say credit card, for example, or some sort of a consumer credit as well. It's a much bigger market, and what we have seen is a similar kind of pattern. There is a bearish symmetry in place, and what we have seen is that whenever the market has declined, rallied about this much, there has been a selling which has come in, and this is what we have seen. Just like the 30-year Treasury bond, it broke this trend line here, and right from this kind of structural low, it found some support come in. The market is rallying, it's also right in that region. In fact, let's take a look at and draw our 38.2% Fibonacci retracement. It just closed right above there, so we'll be watching this closely as well next week, and it could also be just an oversold situation. I am also looking at a potential ABCD pattern here. Let's take a look. Yep, so there was also an ABCD pattern here, a market being a little bit oversold, and perhaps we are seeing a bit of a rally. But again, the FOMC meeting, which will be taking place, I believe, the last week of around 24th, 25th of July, we'll be watching what the markets are likely to do in anticipation of any news with regards to the interest rate hikes. Now we are going to take a look at the 2-year Treasury Note of constant maturity. So this is the shorter end of the curve, and what do I mean by that? So we really have to plot the yield curves in which we look at the really short duration, because there is of course overnight funding that takes place between the institutions. Those are the kind of daily rates, the swap rates which are applied, and then we have of course the even shorter term debt instruments of duration of 1 week, 2 week, 1 month, 2 months, 3 months, 6 months, 1 year, and 2 year is kind of an instrument or a treasury note which the Federal Reserve like to follow, in my opinion. And the reason I'm saying this is because just trying to take you to the weekly chart here. I will just squeeze it a little bit so that's easier to see. So this chart, what it shows is that here we go, that going back to 1981, August of 1981, that's when the rates peaked. So this is a really shorter term. It's very sensitive to interest rates movements. That's when the interest rates peaked. And whenever there has been a rally of about this much, this is the concept of the market symmetry again. Let me just clone it here. We have seen the declines in price, declines in yields come in. So the yields begin to decline. We take another clone of it. There you go. Another clone of it. And there you go. So this is going back to the September of 2006, and then what we can do is try to do the same thing here. And what we are looking at is that in fact the rates have gone up a little bit, but they are forming kind of a potential double top. It's not a confirmed double top formation, and that's the kind of thing which we had seen somewhere around here. It's not exactly the same pattern. One of the things is that I have not personally gone and looked at this, but if you actually look, the rates peaking around in the June of 2006, there was a secondary peak, and that's when we know that the great financial recession started. And here it appears that this is the 2000s, so the dot-com bubble. Their interest rates were moving higher and higher. It formed a secondary peak here of this bigger peak going back to December of 1994, and we know that a recession started here. So it looks like the interest rates, they like to form a secondary peak, or they like to retrace somewhat after. So they rise to this kind of level that we have seen here in terms of the symmetry, and then they decline a little bit, and then they begin to rise again, and they form a secondary peak, and after that there is a more persistent decline, and which is usually followed by a recession. So maybe if that is some sort of thing which might actually play out if when the Federal Reserve in fact decide to pause for quite a few months or longer term, that might be an indication that perhaps we might be starting into a recession. But the interest rates going lower would also be good for certain kind of asset classes which like lower interest rates, because that way the valuations begin to increase. The credit, the pressure on the credit it becomes less, and also businesses such as smaller businesses, their financing situations begin to improve as they are having to pay less amount in interest for debt servicing, and then the whole cycle begins to form again. However, this is what we are looking at for now in terms of what the debt markets, based on the three instruments that we have looked at, that is the 30-year Treasury bond futures, that is longer term long bond futures, then the 10-year Treasury Note futures, and then also we are looking at the 2-year Treasury Note constant maturity, and we have also looked at the concept of market symmetry. Now it'll be really interesting to see what the Federal Reserve is likely to do in their interest rate hike situation, whether they're going to raise interest in July, although the rhetoric that has come in is that Federal Reserve is in fact looking to raise interest rates maybe once or twice by the remaining end of 2023. But what we are also looking at the charts and the price action and the clever minds that operate in this marketplace, we will get some sort of an indication from price action as well. That's why we like to also take a look at the technical analysis side of things to make that sort of an assessment. So thank you very much for watching the video. If you like our analysis, how we look at the markets and try to spot the patterns in the market, how we use our tools such as ABCD or 1-to-1 projections, and the Fibonacci ratios, retracements, expansions, price projections. Please do subscribe to the channel, and if you found this video of educational value, then please do hit that like button. It gives me an indication that people find my videos of educational value, and it encourages me to keep on producing more for you guys. Thank you very much. Good luck and good trading.